In today's video, I'm going to talk about the upcoming US stock market crash that will happen in 2021 and why there are already several warning signs signaling an imminent crash. Most importantly, stick to the end as I'm going to share with you a few ideas on how you can profit from this. Hey traders, this is Mike Sir here. I've been an active trader for over 21 years and a trader coach for the past 15 years. In this video, I'm going to share with you my research on why there's a high probability that we'll have a stock market crash or correction in 2021. First off, let's look at the facts. Number one, inflation risk. Inflation is here as reflected in the increased cost of goods and services that we all consume. We can see it when we go to the supermarket, go out to our favorite restaurant, or fill up our car at the gas station. Everything has gotten more expensive. And this is reflected in the US Consumer Price Index, which measures the average change in prices that consumers pay for a basket of goods and services. The index shows that the inflation is at its highest in 13 years and has risen 5% just in May alone. And these inflationary pressures will keep rising due to several factors. One factor is the $2 trillion plus in savings that Americans have accumulated during the pandemic and ready to spend on trips, cars, and services. Another factor is the trillions of dollars in the Federal Reserve debt purchases. Also, the $3 trillion in fiscal stimulus that was passed by US Congress. Also, the low interest rate environment, which has really been the catalyst for the US stock market reaching all-time highs in prices and the sky-high real estate prices. Here's what Warren Buffett, the billionaire investor, had to say about inflation.
Very substantial inflation. It's very interesting. I mean, we're raising prices, people are raising prices to us, and it's being accepted.
All these factors that I mentioned will force the US Fed to try to contain inflationary pressures by raising interest rates with the hopes that it won't damage the recovering economy. However, due to the pandemic, global financial markets have been pricing in a low interest rate environment for the foreseeable future, and any hint of raising rates would definitely shock the markets. And this is exactly what happened just recently. On June 16, 2021, Fed Chairman Powell said at the most recent FOMC meeting that they may raise rates twice in 2023 and possibly start raising rates as early as 2022. Now, these comments spooked the markets and caused the US stock market to fall immediately after his comments. This negative reaction tells you what could possibly happen next if the Federal Reserve is forced to raise rates much sooner than expected. And based on previous history, every time the Fed has tried to raise rates to slow down the economy, it has gone into a recession. Here's a chart of the US federal funds rate from 1955 to 2020. This is the interest rate that banks charge other banks for lending them excess cash from their reserve balances on an overnight basis. So basically, it's a good indication where interest rates will likely head towards. Now, what I want you to do is focus on the gray shaded area right here, right here, right here. This is where the US has experienced a recession. So let's start off in 1985, where the economy was doing very, very poorly. You can see the Fed funds rate slowly decrease. And then we experienced Black Monday, which is in 1987. But ever since then, the market had rose. So you can see here that the Fed funds rate started rising very, very sharply. And then they were forced to drop the federal funds rate, and you can see that the US had entered into a recession. Same thing here in terms of in 1999, the federal funds rate were rising rates to try to slow down the economy, and then you can see that we had a dot-com crash here. So the US went into a recession. Same thing here in the peak in 2007, they were raising rates very rapidly. Starting in 2005, only to see the financial crisis in 2008, 2009, and you can see the Fed funds rate slowly decline. And what's interesting here is that the Fed funds rate was slowly increasing since 2015, only for them to reduce the rates mainly due to the 2020 pandemic. So if it weren't really for the 2020 pandemic, In actuality, probably interest rate would rise and the US economy will likely head into a recession. So the thing to keep in mind is as interest rates rise, the US economy will get closer to a recession. Another sign of a potential stock market crash is the fall in values of a lot of risky assets. Now, before we talk about the explosion in prices of Bitcoin and cryptocurrencies in 2020 and 2021, please stick around till the end of the video as I will share with you a trade setup that I'm looking for to profit from the fall in the US stock market. Now, in 2020 to 2021, traders and investors have been piling into what I categorize as risky assets, such as Bitcoin and highly speculative cryptocurrencies such as Dogecoin, as well as meme stocks such as GameStop or AMC in the hopes of getting rich quick. Now, for some, it has made millions for a lot of traders, but for the majority who have been caught holding this speculative bag, it has led to dramatic losses. So let's take a look at the following charts. Here's a chart of Bitcoin. Since hitting a high of $65,000, it has fallen 50%. Dogecoin hitting a high of around 75 cents and falling over 75%. And GameStop having a 90% volatility, rising a couple 100% only to see it fall 90% and then slowly recovering. Another sign of market weakness is when we see many public company insiders, whether it's a CEO or CFO or management team, sell their company stock. Now here's a chart of the insider weekly sell versus buy ratio from Whale Wisdom. This is essentially the ratio of the weekly buying and selling of company shares by officers and directors at US public companies. And based on this chart here, you can see that clearly that the number of sellers outnumber the number of buyers by 7 to 1. So you may be asking yourself, why would a corporate insider sell their stock if they believe the company is doing well and their stock prices can go higher? Or even if the company was doing well with stock prices at all-time highs, man, if I were a corporate insider, I'd probably sell too. Now let's take a look at past stock market crashes and see if we can learn anything from the past. Here you can see a chart of the S&P 500, which is the main barometer for the US stock market. Now I've outlined all the stock market crashes that have occurred in the last 40 years here. Now you can see the big drop in 1987, referred to in my previous video as Black Monday. Also the dot-com crash that occurred in 2000, which lasted for a few years. Also the financial crisis in 2008 to 2009. And as you can see here, there hasn't been many meaningful crashes. Some small declines in 2011 and between 2015 and 2016. And recently we saw the COVID pandemic crash in 2020. What we can immediately conclude from this chart is the best time to buy was after each time the US stock market crashed. However, the markets are now at all-time highs here in July 2021 and has essentially recovered all the losses due to the pandemic in 2020. Now, due to how extended we are we due for another crash or correction? One thing for sure is a crash or correction will happen, but the million-dollar question is, when is it going to come? Let's take a quick look at the current state of the US stock market. Now, before we look at the charts, please take a moment to like this video. I would really appreciate your support. Also, comment below, with borrowing costs about to rise, what do you think is going to happen to the real estate market and the stock market? Do you think that there is going to be a stock market crash this year? Okay, so let's take a look at the S&P 500 chart from 2019 to currently to July 2021. So what I've done here is extended a trend line here from early 2019. You can see here it hit every time, here, extended all the way out. Here's the point where the S&P 500 was pre-pandemic, and it fell about 35% all the way down to the March lows here, March 2020. So if you were to account for this is a 35% drop, and where we're right now, it's basically a 28% rise from the pre-pandemic highs all the way to currently. If you were to measure from here, it's basically almost 100% return from the March 2020 lows to currently July 2021. And also here, some trend lines here extending all the way out. You can see basically in the last year or so, the market has been grinding slowly up. You can see a little bit of a blip here, but overall the markets are signaling right now to us, at least it's not ready to drop just yet. Now stay tuned for the video next week where I'll profile the type of chart setup to look for when we see signs of a stock market crash. So the million-dollar question is, how can we profit from the upcoming decline in the US stock market? What are we going to trade? What's the trade strategy? How do we know when it's time? I'm not going to give you any financial advice right here, but I'll give you some ideas to consider. So one idea I have is to buy puts option contracts. So you buy the contract that gives you the right to sell an asset at an agreed upon price. So one of the assets that you may want to consider is looking to buy the put option contracts for the indices, whether it's the S&P 500, the NASDAQ 100, or the Dow Jones 30. These are the three major US stock market indices. Or you may look to buy put option contracts for stocks, companies like Tesla, Apple, Microsoft, Visa, JP Morgan, or any stock that you believe will also fall when the US stock market falls. So what you want to do is want to buy the put option contracts, and if the prices of these assets fall in price, then the price of your option contract will go up in value. The second idea that I have is to short sell stocks. So essentially you want to do is borrow a stock from the broker and sell the stock into the financial markets. Then you buy back at a lower price and return it back to your broker. So you can do this with any stock as long as there are shares that you can borrow from your broker. The third idea is to short futures contracts. What you want to do here is you want to sell the underlying asset to the buyer for a fixed price today at a future date. So the asset could be an index. It could be the S&P 500, NASDAQ 100, or the Dow Jones 30. Now, if the price of the asset goes down, then you exit your position with a profit by buying back the contract at a lower price. Now stay tuned for next week when I break down the price charts and share with you some ideas on how we can profit together on the upcoming 2021 crash. Thanks for watching. If you like this video, please smash the like button for the YouTube algorithm, hit the subscribe button to watch more videos like this, and hit the notification button so you'll be notified of future videos.